versus Business Broadcasting. And it's with me, Julius Nsubga, right here with the financial markets. And at midday exactly, we shall be having the Forex, so stay tuned. So now let's just finish up with our segment right here on the financial markets with what it takes to list your company on the stock exchange. And we basically had a look at some of the first few things that you may basically have to know. There are about, say, 24 requirements. On the list side, there are about 24 requirements for you to list on the exchange. And we saw that you must have a certificate of incorporation, and also you must have a declaration by the sponsoring broker. You must have also the memorandum and articles of association of the issuer, and copies of the document provided for inspection pursuant to the proposed issue. So you must have the copies of documents provided for inspection. So yes, you must be basically a company that really is existing. Then your officers must be basically seen, and everything must be really on point for you to be basically to be able to be listed on the stock market, because you're going to be getting people's money. If you have no location, how then would you be located, and what kind of a company would you be anyway? So that is very important. Then you must have financial reports for the 3 to 5 year period preceding the issue. Very important. So financial reports at all times will always be very important, because you can actually tell how a company is performing by just merely looking at its balance sheet, or probably at its profit and loss account. And these documents will always bring the truth out. Well, you can have very good gross profits, but what if you have very many expenses and you have a very little profit margin? That would be quite something to know. Probably you may have to, that tells that you may have to reduce on your expenses so as to increase on your net profit. So the financial reports for the 3 to 5 years, these are projections. I think it will be very much important to put the projections and also your past performance. And of course, many things are taken into consideration. Many times, the share price of a company will depend on a number of factors, but one of them, and one of the most significant ones, is the leaders, or probably the leader or the founder. That will be very important. So because for people to invest, they must know who is the leader, who is behind this. And sometimes, because we're humans, it is only sentimental or human to do that. Who is behind a particular brand? And there you can be able to make a decision based on a general who is behind there. If you have, in finance, we have something we call, you are employing a 10. A 10 is someone who is way up there and talented and very good at what they do. But an 8 or a 9 is not yet there. And a 7 is basically not one to go for if it's a huge company and also with high standard requirements and quality. Then probably you may actually you won't need a 7. But 10s are very good. If a 10 is behind your company, then probably it can be quite something. So it can be exciting to invest in that company. Every company that is listed on the exchange, good people behind them, you will find shareholders following, or probably you will find the public following and investors following with them. So it is very important to note that there are different factors that make a company successful. Private or public structures must be in place. And 3 things: good product, you have a good product, and then you have good processes, and you have good people. Those 3 things determine your company's performance and size, and also if it will basically leave live to last. Every investor wants a company that will live to last. So these requirements only help any particular company to meet the requirements of what it takes to really have a skin in the game and be productive and also give a return on investment to their investors. So, and then number 14, you must have a list of existing shareholders. Well, it is very much interesting that when you're starting out in a company, you are probably the founder. You're only one, and probably you're having a very, very small office, probably even sometimes with a freelancer. And there, it is very much okay to really run alone when you're starting out. But the more you bring on your partner or probably co-founder, you break out the shares even, and probably, or maybe so sometimes by agreement, you remain the major shareholder as the founder, the real founder, and you have other co-founders coming on board. So you find your shares basically kind of reducing in your company, but sometimes it's important to keep control, because that is really what gives you a glimpse on making decisions in the company. If you're the founder and then later on sell your shares away and remain with the least shares in the company, it means you don't have a right to basically be the final decision maker in the company. So by all means, you have to manage ownership. Issues of ownership are very much important in corporate governance. A list of existing shareholders, you must have them. Who are the shareholders? So in other words, who are the owners of the company, the private company wanting to go public? You must have as well the management contracts if applicable. Yes, all these contracts are very much important. Every person, all contracts of all the senior managers and all the other existing employees by contract or by any staff in management must actually, you must really bring them. You must attach those contracts. And then 16, you have to have a letter of undertaking of the issuer. And then material contracts, of course, contracts that probably you have come up with other companies. These are basically contracts with other companies, or probably as a result of doing business, you get into contracts with other companies or probably with other partners. So you have to really be in position to basically show that. 18, you must have a reporting accountant's report. You must have a reporting accountant's report. For the avoidance of doubt, the reporting accountant's report shall be prepared by a firm different from the one carrying out the audit of the issuer. So your company must always be audited before you go public. And when that happens, well, it should actually only happen if it is done by a firm that is well detached from you, because it won't depend basically on what you have to basically say. And you must pay a fee to that company, to that auditor firm, to basically come and carry out the audit. Say Ernst & Young coming in to audit your company before you go public. And many of these audits will be done independently without based on what is available, based on the available accounts, not really forgery and all that. So that is done to be maintained, to maintain the standard and the trustworthiness, and to maintain the real company's performance. If it's basically not one to be proud of, then probably the audit must show that. And if it's one to be proud of, the audit must show that. So by all means, you must have an auditor, an external auditor, different from probably the one that you're in contract with currently, so that there can be a very fair ground for for fair information, and also good information shared. For good information, and also the accounts must be accurate. whether good or bad, doesn't matter. For an applicant that is already listed on another and is applying to list by way of introduction, letter of no objection must be submitted from the regulator and stock exchange of the primary market where the applicant's securities are listed. Sometimes it is very much possible to list your company on a second stock market. For example, you can come from Uganda and list your company on the Uganda Securities Exchange, and at the same time go to Nairobi and list on the Nairobi Securities Exchange. So that is something that's very much possible to do. By all standards, nothing limits you from it. Is by the way, if you have the shares, and if you have the guts and you have all the structures in place, then nothing can really stop you from listing on more than one stock market. So, well, in 19, you must basically, that is 20, you must have also the following or immediately prior to listing, at least 20% to 25% of the shares must be held by not less than 100 shareholders, excluding employees and direct family members of the issuer. I think this is something that probably we may have to take note, because it is one of those specifics. Unless you have them, nothing happens. Following or immediately prior to listing, at least 20 to 25% of the shares must be held by not less than 100 shareholders, excluding employees and direct family members of the issuer. So by the time you go public, probably you must have had some bit of skill on how to manage different people and owners, say shareholders. So any publicly listed company will by no means be owned by quite a number of people. You can only have the majority shareholder by agreement, or probably by contract. But it is very important to note that by all means you have to have 20 to 25% of the shares in the company held by not less than 100 shareholders. That is quite something, right? So by the time you go public, you have had some skin in the game, and you really know what it takes to really have, say, 1 million people who have bought into your company, or 100,000 or 500,000 who have basically bought a part of your company, or probably a part of your stock when you go public. So you even become more scrutinized when you go public. You don't have any kind of secret. Everything should actually be put out there for the public to see, because they are part owners of the company. And I know that many of you are basically buying shares through local apps that are basically coming in to give a platform for buying and selling shares in different companies, even including US companies, for example, Amazon and Tesla and Google and Microsoft and so on. So it is quite a very interesting innovation. You can look out for them and then probably see if you can try your luck. You never know. You may just return a profit 10 years later. The value of your stocks may be quite even more valuable. So let's go further and look at some of the requirements. So you must have this in mind as well. The company should be engaged in substantially the same business and management and share control throughout the last 3 years before the application. Well, this is quite something important, and I think it's done for reasons that are probably more to do with sustainability. So the company should be engaged in substantially the same business and management and share control throughout the last 3 years before the application. So you must have that consistency with management, and you must be in the same business, and you must maintain the same share control throughout the last 3 years before listing on the exchange. So, and then number 22, the securities for which listing is sought must be freely transferable, subject to any restriction that may be imposed by written law, have only one class of voting shares, which shall be offered at the exchange. So that is something also that probably you may have to note. And then you have to have the name, history, and description of the company's interests and activities. Well, I think this is quite very much interesting as well, because history should. Why do they ask for history? Because, I mean, history is what really defines us. But, of course, it defines us by the fact that it is history, yes. So while the future may be changed, we have a chance to shape it. But history is what really makes us. So everything you do now is going to be history, and it must be able to impact on the future. So the history of the company probably should be clearly put out there, because you have to have an understanding of where the company has come. And most times, if the company has stood the test of time and has basically had a very good track record, most times probably they have very good IPOs, keeping other factors constant anyway, because sometimes it may not really be the same. It may not be so. So the description of the company's interests and activities should also be outlaid right there, because there should be a very level ground for such information to flow right to your shareholders, to other stakeholders, and to the authorities that are basically granting the permission for you to list. So you must have a report of the company's auditors in respect of the last completed financial years, 5 for the first tier and 3 years for the second tier of the company, if the company has been in existence for 3, 5, or more years. So most times you are wondering, well, what amount of time does it take for me to really, do I need to take 20 years if I'm a private company? What amount of time does it take for you to list on the company? Or probably since it was founded, what is the acceptable amount of time that the company should have existed before it lists on the exchange? I think it is very clear that probably you can see here that you can have a clue here that if the company has existed, say 3, 5, or more years, this is a very clear indication that probably you can list even when you're 5 years, or probably as young as 3 years. But you must have all these things in place. This is not the only requirement. There are many other requirements that probably you may have to look at. Even the forecast earnings and dividends. Well, forecast earnings are basically you like predicting how much are you going to basically give back to investors, probably to shareholders and to stockholders. I think forecasts also help to really pave the way and also just give a glimpse of the performance of the company in the next quarters or probably in the next few years. And even the dividends themselves, probably you may want to wait and sit and see, what dividends is this company going to pay dividends anyway in the first probably say 2, 3, 5 years. So you must know that the investors must have a very clear expectation of what this could be. But many companies will pay out dividends based many times on the performance of the company. If the company makes a loss, it means the shareholders also have made a loss. And so have the stockholders, by all means. And so it is not really a mandate that you have to pay the dividends, but it is only a matter of strategy, and also a matter of what do we stand for and what do we want and how do we see our company probably in the next 5 to 10 years. If you want to make an investor happy, of course, paying a dividend will always be the only way you make them happy, and having a return on the investment for date. If it's private equity, probably the value of the company could actually be something good for them. And also they'll have to know what are the exit strategies for them. So by all standards, dividends will always be something that probably you and I will be looking out for, and that's for shareholders. And then number 26, details of share capital structure, the loan capital and the borrowing powers of the company. You must have the details of the share capital structure and loan capital and the borrowing powers of the company. So we must know, does the company have any debt? That is quite something to know. And many times, if a company's debt to equity is very high, then probably you may want to reconsider. But if a company has a reasonable debt to equity ratio, then probably you may have to say, okay, maybe this borrowing is part of business. And at any one point in time, you may have to want someone to come in and probably chip in and probably just try to lift you up at the moment. But your other components of the business have to keep going, and they have to really show some bit of basically moving forward. And so that is so you must have the share capital structure. Who owns what? And you must have that clearly stipulated, and you must also have the loan capital and borrowing powers of the company. So it is very much important. And most of this probably you may find that this is where the balance sheet helps us. You know the shareholders, you know the share capital structure, you can also get the date. You know the date that is basically there. And you must also stipulate the borrowing powers of the company. Is the company able to borrow again? Because probably you can't, there's a certain level that you reach and you can't really borrow anymore. And the more you do that, the more you're digging a ditch for yourself and for the company and your shareholders. But however, borrowing money is always business. So that should not really be something to be afraid of. And then probably a few other comments by the exchange. It says the committee may in its discretion grant exemption from compliance with any provision under these rules and provide that it is justifiable, and upon terms and conditions it may think fit, the authority shall be informed of any decision to exempt an applicant from compliance with these rules. So these are basically what you may have to know, or probably what you may need to know before you list your company on any stock market in Uganda, and probably, to be specific, on the Uganda Securities Exchange. And so that is it for what you need to know before listing your company. And these are some of the things probably we struggle to basically find around. And well, you've been wondering for a long time, can my company go public? Can our company go public? This is it. And are you really ready to go out there, answer to the public? This is it. So by all standards, you have to weigh and see where probably you may like to be. You may like to be, so it's either you stay private or probably you go public. You may have to weigh all those and see what really works for you. And this has been it. And well, just recall that Financial Markets comes to you Monday to Friday, 10 to midday. And then with my colleague also, Marcelino, coming up at midday with lots and lots in Forex. And just recall that it is very important to keep financial markets right at your fingertips. And some of the economic indicators that basically help you and I make very good investment and business decisions. Remember, this is where we give the best of business broadcasting, and also it's all about driving business. See you tomorrow, same time. Julius Nsubuga.